Waiting just 10 years to invest could cost you over $700,000. Because time, not money, is the most powerful asset you have.
Okay, so if you've been on social media at all recently, you've probably seen this idea floating around. It's pitched as this incredible financial cheat code that sounds just a little too good to be true. Today, we're going to break down exactly what it is and why it might not be the golden ticket everyone says it is.
That's the exact phrase they use, right? The wealth cheat code. They sell it as this secret playbook the super rich use to live these amazing lives without ever really paying for it. It's a tempting idea for sure. But the real question is it a cheat code or is it a trap?
So here's the pitch. It's pretty simple. Step 1, buy assets. Stuff like stocks, real estate, maybe even crypto. Step 2, borrow against those assets to pay for everything. The fancy cars, the 5-star vacations, all of it. And since it's a loan, it's tax-free. Then, the grand finale. When you die, your heirs inherit everything, they get what's called the step-up in basis, and poof, the debt and the taxes just, supposedly, vanish. That's the story they tell anyway.
Yeah, let's just be completely real here. For about 99% of people who try this, that story is a fantasy. This isn't some genius wealth strategy. It's a financial suicide mission. The math just completely falls apart, especially in the world we're living in right now.
This slide really tells the whole story of why this idea even got popular in the first place. Just a few years back, in 2021, interest rates were scraping the floor, around 3%. You could kind of squint and maybe see how the math could work. But today, we are in a completely different universe. Borrowing money is way more expensive, and that one single fact turns this entire strategy into a recipe for disaster. Okay, so let's walk through a super simple example and see how this whole thing, how it collapses. We're going to ditch the social media hype for a second and just look at the cold, hard numbers. All right, let's imagine you've got a house, a nice one. It's valued at a cool $5 million. This is your main asset, right? This is the foundation of your whole buy, borrow, die plan. So you follow the plan. Over the years, you borrow against the house to fund your lifestyle. Let's say you take out about $2 million. But with interest compounding over time, especially at today's rates, that loan has just ballooned. Now it's a $3 million debt hanging over that house.
So, fast forward. What happens when you're gone? Well, that step up in basis thing is real. Your kids won't have to pay capital gains tax, which is nice. But that $3 million loan, it doesn't just magically disappear. That IOU has to be paid back, and that usually means selling the house. So what are your kids actually left with? $2 million. And this is the part they never talk about in the TikToks. You didn't cheat the system. You didn't hack anything. All you did was spend $3 million of your kids' inheritance to fund your lifestyle. You didn't build wealth, you actually lit $3 million of it on fire.
And remember, that was with a house, which is a pretty stable asset. It gets a whole lot more dangerous when we talk about the other things the online gurus tell you to borrow against. This is where the risk factor just goes through the roof.
Oh yeah, they tell you your personal ATM is everywhere. You've got a stock portfolio? Take out a margin loan. You own your home? Slap a home equity line of credit on it, a HELOC. These are the cornerstones of your financial life, and they're telling you to treat them like a debit card.
And here is the absolute nightmare scenario with stocks. Let's say you have a $500,000 portfolio, and you've borrowed $250,000 against it on margin to buy a cool car. Then, boom, the market tanks. It happens. Your portfolio gets cut in half. It's now only worth $250,000. Your broker doesn't hesitate. You get a margin call. They want their money back now. And to get it, they just sell everything you have left.
And just like that, it's all gone. Your account balance is zero. Not half of what you had, not a quarter, zero. All because you used your long-term investments to pay for short-term fun. And this isn't some made-up story. This happens to people in every single market crash. It's brutal.
As terrifying as watching your entire stock portfolio get vaporized is, there's something even more fundamental, something even scarier that this advice puts at risk.
When you open a HELOC to fund your life, you're literally betting your family's home. If the economy gets rough and property values start to drop, banks can get very nervous. And yes, they absolutely have the right to call that loan due. If you can't come up with the cash on the spot, you could lose your home. It's the ultimate risk.
Okay, so if borrowing to buy stuff is a huge trap, does that mean all debt is bad? No, not at all. But the truly wealthy use debt in a way that is the complete opposite of what these TikTok gurus are preaching. This is the real secret.
So let's just look at this side by side. On the left, you've got borrowing for consumption. That's using debt to buy things that go down in value. Teslas, Rolexes, vacations. It eats away at your net worth. On the right, you have the smart way, borrowing for reinvestment. You use debt to buy more assets, to grow your portfolio. One path buys you a temporary lifestyle. The other one builds you lasting wealth.
So what does that actually look like in the real world? How does smart money play this game? Let's go back to our $5 million house example and do it the right way. Okay, so instead of borrowing that $2 million for toys and trips, you take that same exact loan and you reinvest it. You go out and buy 3 more houses, 3 more assets that produce income and go up in value. So now, what's your situation? You don't have one asset and a big liability. You have 4 appreciating assets plus a brand new stream of rental income.
And here it is. This is the whole game. The income, the rent from those 3 new properties is what pays for your lifestyle. You're not selling off your assets to live. You're living off the cash flow your investments create, all while your core wealth, your 4 houses, is protected and keeps on growing. That's how you build something that lasts.
All right, let's wrap this up and bring it all home. When you see these financial cheat codes online, it is so important to look past the flashy promises and understand what's really going on. Because that's what this is. It's a debt trap, plain and simple. It's just dressed up to look like a sophisticated strategy. It hooks you with the promise of a luxury lifestyle right now without ever telling you the devastating price you'll pay later.
Look, please, whatever you do, don't gamble your family's financial future on something you saw in a 30-second video. Because in this game of borrowing to consume, there's only one consistent winner. And it's not you, and it's not the guru selling you the dream. It's the lender, cashing your interest checks every single month.
So I'll just leave you with this one question. Take a hard look at your own financial plan and ask yourself, are you building a temporary lifestyle or are you building long-term wealth? Because that choice right there makes all the difference in the world.
So the biggest mistake isn't investing wrong, it's starting too late. Subscribe if you want to use time to your advantage, not against you.